Hello and welcome to this Thursday's morning market briefing. We've got lots to talk about. Firstly, inflation rises with petrol prices jumping, and despite that, Treasury yields fall and fall lower than expected as the inflation data comes into play. We've got lots to talk about on the charts, which we'll come to near the end, so stay around for that. There's lots of opportunities on the charts to do with US indices, the dollar, and Brent crude oil, but we'll come to that at the end, along with the economic calendar, with lots of data being released today, along with the ECB's rate hike decision. Now, let's get straight into it. So US inflation did rise in August as petrol prices jump, with rising energy costs pushing US inflation above forecasts in August, threatening to complicate the Federal Reserve's battle to keep prices under control. Now, we know the Federal Reserve has been lifting rates continuously really until now, trying to halt inflation. However, this kind of issue to do with energy prices increasing, causing inflation to increase, isn't to do with the core inflation, which generally the Fed follows and tracks to make its decisions on whether to raise rates or not. So we'll talk about that in a second, and how this data might actually be quite misleading to what you might think the Fed might react towards it. I know that was poorly worded, but we'll continue. Data released yesterday showed prices rose by 3.7%, up from 3.2% in July, and higher than the forecast of 3.6%. So, the normal inflation figure, yes, it did rise. It rose more than it did in July. But that said, it wasn't the core inflation figure that we're talking about here. We're talking about just the inflation figure, which factors in, gas prices, as they call it in the US, along with food prices, which are very volatile, and so the Fed tries to keep that out the equation. Now, this increase was driven by a recent jump in petrol prices. As we know, the Saudi Arabian government, along with the Russian government, have been pushing for $100 a barrel oil. Some have been actually speculating that this is in a move to get Biden out of power, as it's expected that Trump will be more kind to Putin and Saudi Arabia around their kind of issues that they're dealing with at the moment, especially to do with Russia and its invasion into Ukraine. And so it's kind of believed that because petrol prices are so, such a big factor for so many voters in the US, in terms of their way that they kind of see the economy as running, it's expected that they're trying to make Biden's economy look worse than it actually is by pushing for this $100 a barrel oil. As a result, driving up inflation, driving up discontent with Biden, and as a result, allowing Trump to win in this 2024 campaign. But we'll see how that plays out. Now, this all culminated in a subdued response in the financial markets, with the S&P 500 only dipping 0.2%, and we'll come to why that is now. And certain leading investment strategists such as Roosevelt Bowman said that the Fed will largely look at through the short-term energy spike, when it comes to setting monetary policy. He also said that Fed will keep a sharp eye on the potential knock-on effects of this. However, what he's trying to come to here really is that the Fed will be keeping an eye on core inflation rather than this figure, which factors in volatile kind of assets and products such as oil and food. And along with that, as I said, core inflation generally being more important to the policymakers as it cuts out volatile items. So it is expected that they're going to be focusing on that rather than allowing these short-term energy spikes to play into monetary policy, because as we know, monetary policy takes a long time to see its effects. So there's no real point in taking into account these short-term volatile market changes into their policy. Now, core inflation, on the other hand, rose by 0.3% month on month, which is above July's and above expectations. But that said, we still have to look at this as although these inflation figures are coming above target, well, not target, above forecast, they are still quite tame in comparison to what they could be. And so when you're trying to factor it into the whole macroeconomic climate, it's easy to jump on it and say, oh, well, that's above forecast, and then change your whole perspective on the macroeconomy, when really we're only talking about 0.1% difference between the forecast and the actual figure for core inflation, with core inflation on a yearly basis falling from 4.7% to 4.3%. So that's the difference between July's yearly figure and August's yearly figure. And this is what I'm talking about. So even though there's sort of, an increase over the forecast, it still is the case that it's declining on a longer term basis. Now, rates are expected to stay steady this September meeting, with now investors evenly split on whether another interest rate hike will be made this year. And this is going back to kind of our talks and us looking at Jackson Hole's speech, along with these other Fed officials, which have kind of been giving out mixed messages. But generally, the consensus is rates are staying where they are for the moment. And it's unlikely that they will change. And it's unlikely that they will change this kind of year. However, it is still a possibility. Now, moving on from that, we have Treasury yields to talk about, which actually is in response to this inflation data. Now, US stocks advanced and Treasury yields fell on Wednesday as investors shrugged off the higher than expected inflation report. And this is kind of not what we'd expect, obviously, because we'd think, higher inflation, you're more likely to have a rate increase, especially in the times that we're in at the moment. So the Fed's more likely to raise rates. If rates go up, it's less good for stock expansion and, growth for the economy. So we'd expect stock prices to fall. And with a stronger dollar as a result of an increase in rates, we're also likely to see a fall off in bond prices, generally because less people want them, because they can just put the money in the dollar instead. However, this is not what we've seen. The S&P 500 index managed to gain 0.1%, with the traditionally defensive sectors such as utilities, consumer staples and healthcare being among the best performing segments. Now, the Nasdaq 100 also had a positive day, gaining 0.3%. So as we can see here, it's small gains for these indexes, and we'll come to those on the charts in just a second, so stay around till we analyze those. But yeah, it's small gains on these indexes, but not large ones, that's for sure. But it's not a decrease at the same time. This following inflation data for consumer prices as a result of oil prices increasing. This was the result of high inflation data, with consumer prices rising as a result of the oil prices. However, it was the optimistic core inflation data that was released, which is kind of being represented by the financial markets, if you'd say, far more than what we're seeing with the other normal inflation figure, which isn't the core inflation figure. Now, of course, we spoke about this increase in inflation was expected as well, which kind of played into the fact that the financial markets didn't see as much of a sell-off as expected. But the news caused a sell-off in the US Treasuries, with the 2-year. It caused it caused more people to buy up the US Treasury, with the US 2-year yield falling 0.03 percentage points. Now, it was mentioned that however, that the Fed can't deal with all of its properties within the core inflation figure. And this is kind of playing into the kind of conversation around the limits of the Fed and what it can actually do with the properties within core inflation, such as motor insurance, which is rising by like 16%. It's something that the Fed can't actually deal with, really, because this is just coming with the fact that people are getting more expensive cars, and as a result your insurance is going to be higher because it costs more to obviously insure a more expensive car. And so this is kind of leaving the Fed helpless and unable to control inflation. Now, as we spoke about, Fed rates are expected to stay the same, but in Europe, on the other hand, the rising fuel prices caused by Saudi Arabia and Russia have prompted traders to believe another rate increase by the ECB will be announced today. So keep your eyes open about that. We'll be coming to the economic calendar in a second, where we'll be able to talk about the ECB rate hike decision. But it'll be interesting to see whether it will increase or just stay the same. We've had mixed kind of reports on this that we've been covering, so keep your eye on that. But now swap markets are placing a 64% probability that rates will increase by 0.25%, and we know it's kind of been a half and half feeling about whether rates will increase. With certain ECB officials, being more hawkish and others more dovish, but it does seem like at least the swap markets are saying that it will be another rate hike increase by 0.25%. Now, German bonds, also had a sell-off as a result of this news, with more people expecting higher rates. More people sold off on the German bonds because, obviously, as I spoke about with the US Treasury yields, if you can get more money with the dollar, or in this case the euro, then why would you keep it in the Treasury yields for potentially a smaller gain on investment? But moving on from the articles, we'll now come to the charts, where we've got lots to talk about still, but generally less has happened within the markets yesterday, in comparison to the usual weeks, but we'll still cover it. Now, US indices have consolidated. We've been covering the US indices quite a bit, but it does feel like they're consolidating after coming down to these Fibonacci zones, as we can see here, and that's represented on the Dow Jones as well as the US 100. On the US 100, we are seeing a kind of this small gain over today, but still they are small gains, and they're kind of staying around that consolidation zone that we've been speaking about. And the same really for the US 500. We've kind of been looking out for a proper push from one of these areas, but it doesn't seem like that's going to be the case. Maybe after the Fed rates decision comes out, maybe then we'll actually see some movement on the US indices once businesses are able to understand the true economic conditions and what's expected of the Fed. But moving on from that, we also have the dollar, which is also consolidated, and this is another asset that we've kind of been talking about, potentially having some moves, but it is starting to seem like these assets, which are heavily dependent on the Fed's decision, they are likely to stay around these areas until something takes place. And we had highlighted this 50% mark on the Fibonacci retracement tool, along with this liquidity zone that's around it. However, it does just seem like it's not being able to make that move down. That it has punched up into this liquidity box that we highlighted yesterday a second time now, but it doesn't seem like it's going to be moving anywhere from that. But we'll see what happens today. Next to talk about is the euro, obviously, because we have the ECB rate hike decision today, and it is consolidating around this area as institutions wait for the news on whether there will be a rate hike increase. And it does seem like after the swap markets kind of factored in the rising fuel prices, it does seem like things are more positive for the euro, with an expected rate hike increase today, and that's why we saw this kind of push to the higher areas of liquidity as before, as happened on the 11th and the 12th. But moving on from the euro, we also have the pound yen to talk about. We highlighted this area near the start of the week as an area which is the pound was likely to come down to, because it kind of had that negative push. And we were sort of expecting it to come down to that area, obviously, because this is the bottom of the channel. If we zoom out here, you can kind of see it's the bottom of the channel. So we were sort of expecting price to maybe come down there before continuing a move higher. However, it does seem like it wasn't able to make the full move down there, and it's kind of moved in a sort of retracement style. It's sort of retraced, but not with a great strength or liquidity, just to the upside. So we'll see what happens with the pound yen. Pound yen, sorry. And coming to the US Treasury yields, we had spoken about this earlier with the articles, but yes, the yields did fall. So obviously demand for the US bonds did increase despite the data today, because obviously it was more tame than would be required for a real bond sell-off, and as a result, all we've seen here is a slight decrease in the US Treasury yields. Now, finally to come to is Brent crude oil, which we've been speaking about a lot, but we highlighted once again this area where it'd be ideal to get in a trade if we were waiting to go higher with it. But it does seem like it's been unable to reach that area, but we'll see coming into today. But moves have been made higher, making new highs yesterday, and so it'll be interesting to see whether we will actually move back down to this area of liquidity before moving higher, or it will just continue rallying, because Brent crude oil is looking very bullish, in line with Saudi Arabia and Russia's targets of $100 a barrel oil. So we'll see if Brent crude oil can make it there. But if I was to get back in, I'd be getting in around this 50% area after maybe a rate hike causes Brent crude oil to kind of sell off a bit. But now we're kind of done with the charts, and here we'll talk about the economic calendar with lots of events actually coming up today, as we spoke about, and so that's to talk about certainly. So firstly, what have we got? Well, we've got Aussie consumer inflation expectations data. So obviously if you're trading any Aussie pairs, that's obviously very important. And along with that, we've also got Aussie employment and unemployment figures. So lots of Aussie data coming out today. And of course, we have the ECB's interest rate decision along with their ECB press conference. And so these will be two very significant times for the euro on the charts as well. So if you're trading the euro, keep your eye on that. We've been consolidating on the euro as we spoke about, but these two decisions will have a great effect on how the euro will move, and as we spoke about, it is expected that there will be a rate hike increase. Now, along with that, we also have US commodities inflation data coming out, as well as US retail sales data, which obviously will have a large impact on the way that inflation is perceived. And along with that, we've also got US business inventories. But that's all for the economic calendar. That's all for the articles, and that's all for the charts. If you've made it this far, please subscribe and please hit that like button. It really does help me out. And yeah, thank you so much for watching. I'll see you again soon. Bye bye. See you. Bye.